So we'll go ahead and call the meeting to order. Thank everybody for being here, and hope you're surviving the winter so far so good. That's what we were talking about with Natalka. It's been mild up there, she said.
Yeah.
The first item on our agenda is to consider the minutes of the November 13th, 2019 meeting. Does anybody have any changes? And if not,
I'll make a motion to approve as submitted.
Second.
all those in favor, vote aye.
Aye.
Any opposed? Okay, item number 2, Natalka, you're up. Fourth quarter 2019 plan performance, asset allocation, January 2020 flash report, and rebalancing recommendations for the defined benefit pension plan.
Well, excellent. I hope that folks won't be disappointed if my part of the presentation this time goes pretty quickly, because good news is quick to deliver. Whereas a lot of times you have to explain what happened when things aren't so good. So starting off with just a very brief market overview of what happened during the fourth quarter and 2019. The year ended off very strong in the fourth quarter, and it was an extraordinary year. As we wrote in the first line of our chart wall review, there was a lot of green on the screen. Every asset class did very well, right down to commodities came in very strong by year end. They finished the year at 17%, which was their best return since the commodity super cycle ended in 2007. So if 17% annual return for 2019 was the low end of the range, it was a very good year for both stocks, bonds, and commodities. A couple of other highlights that I will just mention is U.S. large cap stocks led the way globally. They were up 31.5% for the year. Their strongest finish since 2013, and only the 7th time in 40 years that the calendar year return topped 30%. So it was a pretty extraordinary time. Mid-cap stocks came in right behind that at 30.5% for the year, and small caps were the laggards, coming in at 25.5%, and a lot of that, 10% of that, came in the fourth quarter. Starting in September, small cap stocks rallied and were the top performing segment of the market for the last 4 months of the year, but not enough to catch up to mid and large cap stocks on a year-to-date basis. From a style standpoint, there were a couple of months where value did well, but growth dominated once again. And from a capitalization standpoint, large and mid-cap stocks very strong, small-cap stocks less strong. So that was the story in the U.S. Internationally, also a good year, but it lagged domestic markets. Developed markets were up 8.2% in the fourth quarter and 22% for the year. Emerging markets were the top performing equity asset class in the fourth quarter. They jumped almost 12%, 11.8%, and that pulled up their year-to-date return into double digits, finished the year at 18.4%. So emerging market exposure was a struggle last year, and unfortunately in January with the coronavirus, the rally sort of fizzled out a bit, but it could come back in 2020. A lot of demographics are still favorable in those areas. The bond market, again, very strong year in bonds. Rates fell for the year a little over 1%. In the fourth quarter, long-term interest rates actually rose modestly, 14 basis points, from 1.78 to closing the year at 1.92%. That set up most segments of the bond market for very muted returns in the fourth quarter, very flat returns. The Barclays intermediate aggregate was up 0.5% in the quarter, and the Barclays aggregate longer duration, and when interest rates are rising, that's not a good thing. Duration is not your friend, was up 0.2%. However, for the most of the year, interest rates fell, and the Barclays aggregate index was up 8.7%, and the intermediate ag was up 6.7%. And within domestic fixed income, credit bonds, both investment grade and high yield bonds, did very well. High yield bonds were up 2.6% in the fourth quarter, not at all as impacted by duration and rising interest rates, and we're up 14.4% for the year. So your high yield exposure was quite beneficial as well. From a global standpoint, global bonds posted a year similar to U.S. bonds, the aggregate index. For most of the year, the U.S. dollar was strong. That reversed in the fourth quarter. The U.S. dollar weakened. So in the fourth quarter, unhedged bonds outperformed hedged bonds. But for the year, global hedged bonds were up 7.6%, and unhedged bonds were up 5.9%. They were fighting the currency wave. The best performing segment of bond markets globally, and in particular internationally, were U.S. dollar denominated or hedged emerging market debt, up 1.8% in the quarter and up 15% for the year. And you do have good emerging markets exposure with your Brandywine Global Manager. And as I mentioned earlier, real assets also did very well in 2019, led by global real estate, global REITs, up 24.5% for the year. And natural resources, oil prices rose in the fourth quarter, as did gold prices. Finished the fourth quarter very strong, up 7.5% and up 17.6% for the year. So commodities, always a volatile ride, but we'll take a double-digit return anytime. So as I said, it was just a real good year for every asset class. And if you turn to page 6 of your quarterly reports, we can review the plan's performance in detail. And the plan participated very nicely in that strong year. On page 6, we see the plan ended the year with $151.8 million in the plan. During the year, there were $24.4 million in investment gains, and during the year there were $1.5 million in net outflows, benefit payments, other pension plan expenses. What did that translate into in percentage terms? Both for the fourth quarter and for the year to date, the plan pretty much matched its target policy, up 5.3% in the fourth quarter, up 19.1% on a year-to-date basis. Very strong. If you look below in the table, the total plan composite, you'll see your 4 other teams of investment managers. The global fixed income team pretty much matched their target in the fourth quarter, and they lagged a little bit on a year-to-date basis, up 7.5 versus 8.3%. The domestic equity composite lagged in the fourth quarter, up 8 versus 9.2, but and also lagged about 0.5% for the year, but still up just about 30% at 29.7. International outperformed for both the quarter and year-to-date, was about 2% ahead of target at 24.8% year-to-date, and was the strongest performing composite in the fourth quarter, up 10.7. And your real assets, up 3.3 for the quarter and 22% for the year. I really wish I could deliver numbers like this every January. This is a much nicer conversation than we were having last January and February. So, very strong year of performance. If we turn to page 9 of your, page 15 first. Here you have the performance of your individual investment managers. So you can sort of see manager by manager sort of who contributed and who might have lagged. And I'll just point out a couple of highlights. You did made a change in your high yield bond manager. On November 25th, you switched from Principal High Yield to Lord Abbott High Yield. The numbers did not print out here for the fourth quarter or an inception to date number because of the short track record. But for your reference, Lord Abbott, since inception, November 25th, was up 2.1% for that time period. So they participated and captured really most of the fourth quarter return for high yield, which was up 2.6% for the whole quarter. They captured most of that in the 5 weeks that you had them. So off to a good start. Your top performing manager for the year was Brandywine Global Bond Fund. They're mostly unhedged. They only have about 18% exposure to the U.S. dollar. They hold a lot of emerging market bonds and currencies, but they also hold a lot of bonds and currencies in places like Sweden, Norway, some South Africa, Poland, so places that have high real interest rates. And you can see they were up 9.3% for the year, and a lot of that came in the fourth quarter when the U.S. dollar weakened and a lot of their currency holdings really popped. And your your fully hedged global bond manager also posted a strong year of performance, up 6.8%, but did lag their blended target a little bit for the year. Both of those managers are sort of getting reduced in size as we move to the new asset allocation, but it's nice to see that as they're being reduced, they're still contributing very nicely to the portfolio. And so that's really the highlight. You know, Pinnacle continues to do a very good job with domestic intermediate fixed income, and TCW, total return, just as a reminder, they are 95% mortgage-backed securities. So a very good and nice complement to Pinnacle fixed income. As it turns out, mortgages were the lagging sector in the bond market in 2019, but they still for the year matched what Pinnacle put up at 7.3. So their performance, as you can see from the index comparisons we provide you, we show them compared to a dedicated mortgage index as well as the aggregate, and they normally fall in between the two. Highlights on the equity side, you can see that all of your equity managers were up pretty high double digits. Three of them over 30% for the year. Pinnacle Large Cap Equity is still your largest manager And I'll tell you, since 2015, they have just really come on strong. They have really, exceeded their targets, and you can see that their 3, 5-year, even their 7-year track record has really rehabilitated. Brandywine Dynamic Large Cap Value is doing very well in a challenged space, meaning a value manager. Pinnacle is more of a core to growth oriented manager. Your weakest managers are your value managers, and led by Harbor and Virtus small cap value. Virtus had a very disappointing fourth quarter of performance. They were running neck and neck with their index, and they did not participate very well in the pop that small value had in the fourth quarter. It was security selection related. Two of their holdings in consumer discretionary and in industrials, Children's Place and U.S. Silica, were down 18 to 35% and just took down the portfolio in the fourth quarter. Happy to report they're doing well on a year-to-date basis, but was disappointed to see them close out the year on a weak note. Your mid-cap growth manager, Janus Enterprise, top-performing manager for the year. Even though they didn't outperform in the fourth quarter, they still finished the year, in line with their index and ahead of the S&P 500. And your small-cap growth ETF. So, you've got good diversification, and even with the value exposure, your large cap value manager, which is the largest of the value exposure, is doing real well at keeping pace or outpacing the value index. So they're mitigating the weakness of their style. On page 17, you can see your global equity and your international equity managers, and they had a very strong quarter and very strong year-to-date performance. Dodge & Cox has, they've been fighting a headwind. They are a value-oriented manager, but they had a very strong closing fourth quarter. They're pretty heavily invested in European financials, which really popped in the fourth quarter, but it's been a headwind for them most of the year, but they still managed to finish ahead of the broad all-country world ex-US index. Your emerging markets manager outperformed their index by 6%, so sort of overcame the weakness in emerging markets. One of the reasons for that is about 25% of their holdings are actually domiciled in developed countries. So they're sort of companies like Louis Vuitton, Richemont, Prada, some companies that sell luxury goods, if you will, into emerging markets. So that developed market exposure helped them somewhat. We are reducing your global equity managers, American Capital World Growth and Income and Janus Global Research, not because they're not doing well. It's just that they don't fit in totally with the new asset mix, because international equity is being reduced. But I think that what we might do, because Dodge & Cox is sort of challenged because of style and some of their sector exposure, is we're going to take down Dodge & Cox more than planned, and we might leave in Janus Global Research a little bit longer, the stronger of the two global equity managers. Your global REIT manager has really grown in asset size during the year because we're using them as the surrogate for private real estate or direct real estate holdings. So was very happy to see that they had such a strong year of performance, edging ahead of a very strong index result on a year-to-date basis, up almost 25%. And your natural resource exposure has been increased a little bit this year as well. And so was very happy to see that fourth quarter and for the year posted a strong year of performance. So that is, after page 17, you have individual fact sheets for all of your funds, so you can read, if you're interested, more specifically in what some of the things were that helped and hurt performance on an individual basis. I wanted to just try to give you highlights. I didn't want to bury the headline that things went really well for a lot of your managers. On page 9, I'll just quickly review the asset allocation as of year end and the rebalancing recommendations that we made with the year end numbers, which were actually executed on January 23rd. But at the end of the year, the plan was 66% invested in equity, and that's moving towards the new target of 71%. And that 71% target includes global real estate, and it includes natural resources, international and global equity, as well as your domestic. So it's all of the equity exposure. So I don't want you to be nervous about the 71% number. It incorporates a lot of different asset classes within the equity, under the equity umbrella. So making very good progress moving toward that new target asset mix. And we're all year we've been trying to trim on strength and buy in to the asset classes that need to be increased, and that worked very well for us in 2019. There were a few opportunities, for instance, in May and in August, where the market broke and weakened and pulled back rather significantly. That gave us opportunities to actually, buy in at a more reasonable level and participate in the rebound and appreciation. So with that, I was going to move on to a review of January's flash report, but I should pause and ask if there are any questions or comments on fourth quarter or year or the year 2019 performance.
Anybody have any questions or comments? No, I don't see any. I think you can continue on.
Okay. Well, January started off global equities in the red. And perhaps not surprising after such a strong month, quarter, and year to see a little bit of a pullback. The S&P actually ended with a flat rate of return. The Russell small cap index, so small cap equities were the weakest performing part of the market, down 3.2, and mid caps were down 0.8%. As I mentioned earlier, emerging markets got hit in January, primarily with the outbreak of the coronavirus and the uncertainty that was going to have on emerging markets as well as developed international markets as well as global markets in general. That's really what I think was precipitated the pullback in January. Perhaps more interesting was what happened in the bond market in January. After having rates rise 14 basis points, so modestly in the fourth quarter, long-term interest rates dropped sharply in January. They dropped 41 basis points in a month, from 9.2 down to 5.1%. And that set the stage for strong advances in high-quality bonds. There was definitely a flight to safety. Government bonds led the way. They rose 2.4%. Investment-grade corporates followed closely, 2.3%. Mortgages continue to be the lagging sector, rising 0.7%. High-yield bonds were flat for the month. So we might be seeing high-yield bonds sort of slow down a little bit, although when I looked at some of your performance results year-to-date through February 14th, well, I actually looked at them both through January 31st of your funds and then February 14th. And just to give you an example of the volatility that the market has experienced since year-end, in high yield, Lord Abbott for the month of January was flattish, down 0.6. By February 14th, year-to-date, they were up 1.4%. And there have been even more, swings and roundabouts, particularly in the equity markets that pulled back in January rather significantly and then rebounded. So, for instance, Virtus small cap value, January 31st for the month was down 2%. February 14th, year-to-date, up 3.2%. And you see that across a lot of the asset classes and such. So we are in a volatile period right now. But bonds were the place to be in the month of January. The intermediate aggregate index was up 1.2. The aggregate was up 1.9. High yield, I mentioned, was flat. Global hedged bonds were up 2.3%. Unhedged up 1.6%, so very much in line with U.S. bonds. Emerging market local currency bonds were negative because the U.S. dollar strengthened once again. But emerging market hedged bonds, dollar bonds, were up 1.5%. Global REITs hung on to a positive rate of return. They were up 0.8%. Natural resources got pummeled. Oil prices dropped pretty significantly from about $60 down to about $51 at the end of the month. And the North American Natural Resource Index was down 8.3%. It's very energy-centric. But even that has come back as of Valentine's Day year-to-date. The commodities they made up 2%. They're down 6.5%. The global REIT exposure, very interesting. At the month end for January, your global REIT fund was up 2.3%, one of your top performers, if not the top performer for the month. And year-to-date through February 14th, they're now up 6.2%. So it's a time where last year, as well as the beginning of this year, diversification has been helpful to you, and your managers are doing well in a volatile environment. I think we're going to see that volatility continue. I don't think we should expect that 2020 is going to be a year like 2019 was, where everything worked. But I think that equities will still be up high single digits at year end. Bonds are going to be challenged, but I don't think we're going to see I don't think we're going to see interest rates spike up too much. I think we're going to see interest rates either stay level or drop further as we deal with the coronavirus and central banks stand poised and ready to pump liquidity into the system. It's going to keep rates low. And we continue to think that real estate exposure is going to work very well for you in 2020. We did not have any rebalancing recommendations for January. We are going to continue moving towards your new asset mix, but with the volatility, and we've been very aggressively through the fall, through the third and fourth quarter, of the year doing a lot of rebalancing. We just said, let's take a little bit of a breather during this very volatile period, and we'll revisit at the end of February whether we want to rebalance. And that is what I have for December and January performance and asset allocation. And I can make some comments on the investment policy statement, which has been updated, but I don't want to cut off any questions on performance or asset allocation.
Anybody have any comments regarding Natalka's?
Sounds like the recommendation is to stay the course. So, all right.
Sounds like doing good for us so
Yeah.
far, too.
Good year.
Yeah, it's scary, but, there's not a lot of alternatives. You've got a 7% actuarial interest rate assumption that you want to try to meet. And I'll tell you, if every year could be like last year, that would be no problem.
Yeah.
It was a good year. Okay.
I have one question regarding the Invesco Oppenheimer developing markets. Did I understand you to say that while this is our emerging market allocation, 25% of this holding is in developed markets?
That is correct.
Does the style drift give you any concern from our allocation perspective?
Not too much, because the developed market companies that they tend to own generate more than half of their revenue in emerging markets. So even though their address might be in France, might even be in the U.S., might be in Germany, their revenues are coming from emerging markets. So I'm not too concerned with the style drift. And I've found that, for instance, other emerging market managers have done a little bit of the same thing. I mean, American Fund's New World, if any of you are familiar with that fund, it's an emerging markets equity fund, but 40% of that fund is invested in developed markets. But all those companies, now that I sort of, I benchmark that kind of a fund when a client has it to both developed as well as EM markets. So, but no, it does not concern me with Oppenheimer because of the revenue exposure they have to EM. The developed market companies that they own, the fortunes of those companies rise and fall with emerging markets.
Thank you.
Okay, I think you can move on into the updated investment policy statement.
Okay, well, with the shifting to the new target asset mix, it was a good time to update the investment policy statement. And so Melissa and I went through that exercise. The primary sections that were updated were on page 4. Under general investment guidelines, the plan's discount rate was changed to 7% in line with the actuarial report. Also, the eligible asset categories for plan assets were updated to include things like private equity and private debt. On page 5, under the asset allocation section, portfolio diversification guidelines, we just made sure that the wording there suited the new asset mix and also the ranges around the targets, and any specific securities that should be excluded or restricted or not. So that was updated so that it coordinates well with Appendix A. And we also, under the alternative investment section on page 6, added some just information on private equity. The natural resources and the global real estate has always been there. So those were the updates that were made. Otherwise, The other parts of the investment policy have stood the test of time. I think we're still very appropriate for how the plan monitors investment results and what the responsibilities of the investment managers or funds are. That all was status quo. On page 9, you have Appendix A, and that is your new strategic target asset mix. And you'll see there, that's what shows the total equity exposure of 71% and total fixed income of 29%, and the underlying breakouts of that and the ranges, the corresponding ranges. And then on page 10, we have the blended target policy index benchmark that's going to go along with that target, the new strategic asset mix. You might notice that the total equity exposure in that is 68% at this point in time. That is because you're transitioning from the old mix to the new. You're not quite at 71, but you're far above, I think it was, the old one was 62% of total equity. So we didn't want to have the target policy index benchmarks be that far off your actual asset mix. So this is something that I would say that probably by the end of this year, you're probably going to be very close to the 71 strategic target allocation in equities. And so we will update Appendix B at that point in time again, but we feel that during the transition, this is a fair performance benchmark. Any questions on the policy statement?
I'm not seeing any. I would entertain a motion to approve.
So moved.
I'll second.
All those in favor, vote aye.
Aye.
Any opposed? Okay. Thank you, Natalka. I appreciate that. That was a good summary of your changes.
Okay. Well, as I said, I wish I could deliver reports like this all the time.
We do too.
Yeah, so do we.
Makes everybody's job a little easier.
Yeah.
That kind of news.
Yes, and certainly if you'd like me to come down for the next meeting, I'm always happy to come down. Usually the weather is a little bit dicey in February. Didn't know it would, it could have been a beautiful day to fly down yesterday, but...
Well, it was raining here yesterday, so we're hoping it'll be clear weather today.
Dreary.
Yes, very dreary.
Had a lot of rain.
Okay, well, we'll move on then. We also have a funding policy update for our Actuary plan. As you know, we made some assumption changes recently, and I asked Michael to look at this plan in addition to the letter we'd got from the state where they commented they like to see some specific information in there that's not in there, although we're following it. So Michael took a look at this, and on the sheet that's on your desk, I highlighted the actual changes to make them stick out a little better. There are very few here. He added, under the demographics, the forms of benefit payments to be considered, and then the state had asked that we specifically put in that we use the amortization method of the level dollar amortization. So he has put that in the appropriate places. And while he was doing those changes, under the assumptions utilized, he added the mortality assumptions, which we're already following, and he thought this would be a good time to go ahead and put that in. It's things that we're going to probably have to eventually anyway, and so we'll be a little bit ahead of the curve on that. He set just some bullet points that says he's incorporating language which now explicitly states the amortization method which the state reviewer wanted. He's reflecting that the city is considering mortality improvement earlier than required by the Pension Act, and that the optional form of payment assumption will be reviewed, which is contained in the proposed state Senate bill. So other than that, they're fairly minor changes, again, things we're already doing, but we're being a little more explicit in our policy. And if
And
we,
that's in response to the,
For the state.
except for the mortality piece,
Yeah.
yes.
Okay, which is
yes.
just good policy. Okay. Do we need to make a motion, have a motion?
This would be a recommendation to council, and then we'll send
To
it to
approve?
them for a resolution.
Okay, I'll move.
Quick question, if you don't mind, before- so it's specifically notating the level dollar amortization. Is that what we were using? We were just not being specific? Is
Yes,
that
it
what
just
we're
was
saying?
not specifically spelled out in our policy. Okay, I have a motion, I have a second.
Okay. Second.
Okay. All those in favor, please vote aye.
Aye.
Any opposed? No? Okay. For other business, I just remind you to get with Chris if you're interested in having your appointment considered again. June 1st, I believe, is our end date, and the mayor will appoint everybody, plus Cindy's role, and hopefully we'll meet one more time, so we'll get to enjoy your company, but I think it's good for the employees to come and see what goes into our pension plan and how much thought and care that we take with it. So, other than that, anybody else have anything? If not, we'll stand adjourned.